And I'm glad to be able to give a cascade of welcome to both the Minister in your new position and your first bill, and also to the incoming Chairman of the Finance and Public Expenditure and Reform Committee, Deputy Toomey, who was elected the other day, committee which I feel very saddened that I was expelled from by the government, along with my membership of the Public Policy Oversight and Petitions Committee a year ago as a result of voting in accordance with conscience on a conscience bill. But there we go. I'm glad to be able to offer a contribution, a preliminary contribution on this bill. And I was very interested to hear the Minister's opening statement, Deputy McGrath's opening observations, and Deputy Doherty's opening observations, and then Deputies Boyd Barrett and Ross. And it was an interesting mélange of initial response. And all of it had validity. I happen at the moment to be reading Timothy F. Geithner, former Federal Reserve President and Federal Bank of New York President's book, Stress Test, which came out recently. And I think it would be well worthwhile that anybody who wants to contribute to this debate should read it too. And the reason is, it shows you that even with cutting-edge experience and qualification, and a lot of headcount resources in the Fed reserves, and supported also by the Securities and Exchange Commission, which looks after the Wall Street side of things. The Federal Reserve looks after the licensed deposit, the FDIC banks in America. How way behind the curve even the best operated regulators and central bankers found themselves when the crisis began to crack in America. And it wasn't a once-off explosion like a volcano. There were splutterings at first. Bear Stearns went. And the type of leveraged instruments and assets that had been created in the preceding years were hugely badly understood by everybody, even the most sophisticated. And Geithner had actually had hands-on experience on site in the Asian crisis and the previous crises. And this thing was unraveling faster than they could understand it. And it was a fluke, the tri-party obligation transactions had just about been got a handle on about a year and a half before the real, uncontrollable crisis started to hit. The danger, Minister, and I say this, with all due respect, is that it's actually, it's an impressive sounding introduction of a piece of legislation. It is jargonized. It's full of technical type, techno speak. But all of these things in new instruments, new ways of doing business, in mobile capital, mobile exposures, mobile liabilities, mobile insurance products, because that's what they are hugely leveraged and built sometimes on the slimmest of margins. And we don't know, for instance, if we call this bill the Irish Collective Asset Management Vehicles Bill 2014, it's not all about Irish collective asset management vehicles. It's about international collective asset management vehicles registered in Ireland within this. So let's correct that first. And then let's find out exactly, strip them all back to what's behind the facades. What do their businesses do? Whose money is under investment? Where are the destination investments held? Because you know what? If we're if we're the location for the management, whether it's back office management or decision-making management, contractual party positions taking up, we may be assuming, if we put it under the umbrella of an Irish central bank review or regulation, professional indemnity exposures to this country. We have a central bank that's still wobbling from lack of resources, lack of experience, lack of qualification, lack of involvement, lack of what I would call meaningful conversation with the institutions it so-called regulates. As regards the mortgage crisis, which is bread and butter stuff, it hasn't got a clue what's going on in the banks. It really hasn't. It trots out figures, aggregate figures of what amount of arrears are being reported back by the banks. Nobody's drilling down into exactly what's going on. Nobody's asked for sample, maybe 100 cases and explain them at bone marrow level. Jargon is a great veil to hide behind. There's too much opaque glass, too many veils hiding the realities and the nuts and bolts of what's going on. We should be getting into the engine rooms. And I speak from experience. Does anybody remember, Minister, what a CDO is? An SIV you probably remember, Special Investment Vehicle. CDO is collateralized debt obligations, CIVs. These companies proliferated here at IFSC to theoretically improve the cost of capital of international banks that were already highly leveraged. And the transactions that took place on the commercial paper that was issued in America in dollar terms to finance banks that had European balance sheets, when everything started to seize up and credit contracted from the over-leveraged positions that were held by many of the banks, became a very unpretty sight. And I think the questions asked, like, who was really behind the drafting of this legislation, is a very good question. IFSC clearinghouse members are people to be very wary of. I'm not saying that they're untrustworthy, but I'm saying really cross-examine them. Again, get down to nuts and bolts. Quantify everything. Don't be afraid to ask the questions. Tim Geitzner admits in his book, they didn't know what was going on. They had to get special teams to start beginning to learn what was going on. Bear Stearns was rescued in a breathless state of malunderstanding by a bank which equally was in a position of not knowing where it stood. Lehman hadn't a clue. These were all the banks, investment banks, with undoubted reputations. We talk about our reputation. We vaunt our reputation, or we talk about it. We massage it. Do you know what? When you have to talk about your reputation is already gone. A banker said that, and he was right. When you have to protest that you're safe, you're not safe. So I'm saying that the next stage of this bill is going to need an awful lot of close interrogation, examination. And we're not going to gloss over it, because it's too big a cost if everything starts going wrong. We will be the platform for about, what is it? 4.5 trillion. That's 4,519,000 million of funds. Do we know what proportion of those funds are going to be leveraged? You know, people think when they talk about investments that it is just the saved up money invested in the product destination of the investment. It's not. Usually it's leveraged. Even the Federal Reserve in America at the moment is leveraged 77 to 1 times. The normal leveraging level of the Fed was about 20 times. Deutsche Bank, I've said it before in this house, is over 50 times. Lehman was 40 times when it went bust. Lloyd's reinsurance market, we heard about London, the great financial centre of the world. Lloyd's reinsurance market and insurance market almost melted down. From the stage when its reputation, here to that point, had been undoubted, where people made presumptions and people talked in jargon, the jargon of admiration. We hear names like PwC, KPMG, and the Ernst & Youngs being trotted out as, you know, the people who would be making favourable observations and comments about the setting up of this type of arrangement. Let's not forget that just, you know, these are facts. KPMG was the auditor, INBS, which blew a 5.5 billion losses onto the households of the Irish people for 10 years, more. Ernst & Young, auditors to Anglo-Irish Bank. Anglo-Irish Bank blew 32 billion of losses onto the Irish households and citizens. Still there, by the way. People think it's gone away. Pro notes, prom bonds. It's, you know, it's all brilliant. It's more or less gone away. It hasn't. It hasn't. And Minister, if any of those bonds are sold, we're then really on the hook for it. It's like the barb of that cross on the Irish people, because we won't be able to cancel them, which you should do, and the government should do. Because to place that level of losses on the Irish people was wrong. There's an international financial service that this government could do for the people of Ireland. A serious one that would remove water charges until a proper system of investing in water infrastructure and delivering it and funding it is put in place. And similarly for property tax. Those taxes are income taxes by another name. They have to be paid out of income. Corporates, so far, have actually been relieved of any contribution to the national recovery because their effective corporate tax rate for the MNCs is about 6.5%. And you'll remember, Minister, in our parliamentary party meetings, I said from the outset, there should be corporate contribution in a national recovery levy. The government was well able to go and just rob pension funds at levels of 0.6% and 0.75%, which is hundreds of millions. This year, 750 million from the pension funds. And they're afraid to say to the corporates who would pay it, the MNC corporates, lads, could we have for 3 years a national recovery levy of 3% on your reported profits? The profits that you declare to the world in your stateless existence, hovering over tax jurisdictions where they pay no taxes until they decide where they'd like to pay them, and then pay very little. That's not right. Taxes can only be paid from incomes of individuals or corporates. Fact, unless it's a capital gains tax, when on the transfer of the realised difference in the cost of the investment to the point of sale, there's an actual profit cash uplift, and then you pay a little bit out of that in capital gains tax. But otherwise, if you're asking people to